Good morning, everybody. We're joined by Andy LeBeau of Commodity Research Group. Welcome, Andy.
Thanks for having me on, Mike.
Yeah, thanks for joining us. Without further ado, let us know what's going on with the oil markets and the numbers that just came out.
Well, let's start with the numbers first. And they were clearly a set of bearish numbers, starting with the crude number. The street estimates were for a draw of 2.5 million, and of course, it came in as a build of almost 7 million. So you get that big of a delta, and the market is clearly going to react. And today, it's getting hammered. Looking at that number, the reason that we built so much is imports were way higher, I think, than any of us had expected. Certainly, what the street was expecting, and certainly what I had. So, an unexpected build. Is this the end of the draws? I don't really think so, because crude runs were a record up near 17.9 million barrels a day. That's a huge increase. So I think in upcoming weeks we're still going to see some draws, but certainly this build is going to test the market. The other thing I mentioned this last week. The DOE has a fudge factor, which is called the adjustment factor. And this week it was again over 600,000 barrels a day. That's a big fudge factor. So they're clearly having problems with some of the variables here. But nevertheless, the numbers is still bearish. Distillate too. Bearish, rising by 3.7. The street was looking for up zero point 0.7. There too, I think there's some concern that as these runs push out to really record, you're gonna we're gonna build more distillates, and certainly with the cracks being where they are, the refiners want to run for distillate, and distillate demand is really nothing special. Actually, it's coming in somewhat on the disappointing side. Now, the good news is distillates macro still looks okay. Days supply, which is stocks divided by demand, are 33 days. The 4-year average is 37, but nevertheless, we've seen some builds here in the last few weeks, and the real bullish story in distillate, while still bullish, is less so. Finally, gasoline was the most bullish, but as I said last week, gasoline overall is not really in great shape. It doesn't really matter. I mean, we drew 500,000 versus the street estimates of zero point 0.7. I'm sorry, we drew zero point 0.7 versus the street estimate of zero point 0.5. Big deal. Gasoline is in terms of inventories and days supply is above the 4-year average. Demand is nothing to write home about, and it's hard to get excited about gasoline. One thing I neglected to say is Cushing stocks rose this week. Is that the end of the Cushing draws? Could be, could be. We thought, well, last week I think I mentioned I thought there was another week or two ahead of Cushing draws, but we'll certainly see. Canadians are the Canadian production is increasing every week. So I think there's still another week or two of Cushing draws ahead. Of course, the structure has just gotten pummeled here in the last week or two. One last thing to talk about, and it's important, is total stocks. Big build of almost 18 million barrels. And that's all inventories. Propane was up. We talked about crude, and distillate was up. That's a pretty big build. The market has been looking at draws all the last few months, and this build again is, I think, going to be testing to the bulls. But in terms of days supply, we're at 59 days versus 61, which is the 4-year average. Overall, I still think we're going to see inventories draw here, but with a 20 million build, that changes things somewhat. So clearly, a very disappointing EIA number, and certainly the market is reacting to it.
Yeah, thanks. So it sounds like last week you joined us, and we also sold off on the data. Back-to-back reports kind of pointing to this. Is this something that you think is a trend and you're getting more bearish on, or is this more of a seasonality thing? What do you think?
Well, I think that I'm still, as I was saying, I still think crude is going to draw, but a little bit over the next couple of weeks. But certainly, the one thing to note is we are going to head into turnarounds beginning in September and into October and early November, where crude demand is going to soften because crude runs are going to soften. So, yeah, the market is certainly going to anticipate that, and again, I think we'll draw a couple of weeks, and then we're going to start seeing bills as we head into September and October, which again may take some of the bullishness of the U.S. market out. And again, the market is, you can see what the market's doing here. We're breaking down.
Yeah, well, it also, just wanted to give a small update also. It just looks like it also could be part of the broader sell-off that's going on across all asset classes today. And just to update where we are right now, S&P is basically on the low of the day. We're trading down 37 at 28.04, and oil is down at 64.83, which is down 220 pretty much on the low. Metals are really getting hit hard today. Copper, silver, gold. So it's pretty much everything, and that might have a fair amount to do with it as well. It seems like selling across the board.
Totally, I think that's a big factor, and certainly for oil, we've been very focused on the supply side, and when we've talked, well, you and I have talked 2 weeks, but in some of the podcasts that I've been doing, we've been talking ad nauseum about the Iranian sanctions. But I think the market is also beginning to focus on the demand side, and whether higher interest rates, the stronger dollar, as well as the tariffs is going to take out some of the demand growth that we're expecting in the third and into fourth and first quarter. And certainly, as you said, Mike, I think the global markets are clearly looking at that as well.
What's the energy market been looking at? I actually brought up a chart on the right-hand side for the past 6 months or so. It looks like in June we had to move from about this level, about 64. We moved up to 73 or so.
Right.
What was the news, or what was the thought process in the market at that point on that move up?
Well, that move up, there were two things that were pretty critical. One was the anticipation of the sanctions coming on, and two was, you remember, Libya went out, so
Right.
we basically lost. We lost about. We were thinking we might lose 1 million barrels a day of light sweet crude, so the market completely freaked out for good reason. Because you're looking at the loss of Iranian exports on top of the loss of Libyan exports. Libya came back, and the market settled in, and has gotten into a trading range now. But that was basically, that was a supply side rally, no question.
And so, what do you think the more recent reason for, let's call it the last 3 weeks, the move from about 70 to here, has it been more getting back to the fundamentals and these kind of data reports coming in on the showing more inventories?
Yeah, I think that certainly the EIA numbers here the last couple of weeks have been bearish, but we've also seen on, at least on the supply side, we've seen increases, albeit modest, from Saudi Arabia, Russia, Kuwait, the UAE, and what's key is that Iran is still producing where they were. Their exports aren't quite as strong, but their production remains around. I think they're around 3.7, which is right around where the May and June levels were. And what's happened is because of the higher production and the Iranian barrels still being available, people have been buying Iranian barrels because, they know they're not going to be able to, over the next few weeks, because now is the wind down period between now and November 5th. So with all the supply on the market, the physical market has gotten weak. Brent is in a big contango on the physical market. 40s, which is a physical barrel, is trading at like 80, 80 under dated. And you could see on the structure of the Brent market, the front has gone into a contango, and there's floating storage is building up. There's unsold Nigerian. So the physical market is showing some signs of supply strain, but that's going to change, and that's probably going to change pretty dramatically as we start losing the Iran barrels.
Are there any spreads that you're looking at the moment that you think are mispriced, whether it be like brewed versus light sweet, or any other sort of spreads?
Well, probably, I would anticipate that, as we lose the Eastern Hemisphere production, Brent will probably do a bit better than WTI, although, you got to be hesitant to recommend those WTI Brent spreads. But, if you look at the fundamentals, we know that, Cushing is going to start rebuilding here, which should be bearish on the delivery point, on WTI. And we also know that Brent is probably going to clean up, if Asia strengthens. So, I would think, that's something to look at. I think the Brent contango is not going to be long lasting. So that's another thing to, look at. Maybe buying the front and selling the back in Brent. Those are two things that I would be, I'd be watching.
Right. So, we've been speaking for a while, but a lot of people are just kind of hearing you in the community. Tell us a little bit about Commodity Research Group and what you guys focus on.
Well, we are primarily we focus on metals and energy. Ed Meir, who is one of my partners, is consistently ranked one of the top metals analysts in the world, really. Ed speaks all over the world. He talks to Asians and has a lot of great contacts in China, and really knows I think really knows the market very well. Ed's been following metals, I don't know, 25, 30 years. So in terms of base metals, I really don't think there's anybody better than Ed. My other partner, Jim Colburn, is an options guy. Wrote a book on commodity options, primarily energy. Jim and I worked together at Man Financial for many years, and then at Jefferies. We write a monthly report, which is all the commodities. Ed writes most of it. I write the energy, and Ed does a daily report. And we've been getting into podcasting, over the last year or two.
Yeah, that's great. And we actually have on our website up your latest monthly report, and that's in the expert research section of the main website. And so you can kind of get more of a sense of how they view the markets and all the different products that they cover. It's a lot of good information.
And as a matter of fact, I'm about to do a weekly podcast, which should be available, I would say, sometime later today or tonight, which we'll send to you, Michael.
Yeah, great. And we'll post that tomorrow if that's, as soon as you send it, that'll be in the expert research sections. That's great. I guess, any thoughts right here? Any key levels you might be looking at based on the global risk environment and where energy is trading?
Well, I'm still seeing it as I still think crude is going to be in a pretty wide, still in a trading range. I think we're getting closer to the low. Certainly, this action is not, I don't think is all that conducive to going out and buying the market. But maybe 62, 63 on WTI. I think that's going to hold because you look at as we mentioned, as we've just talked here, Mike. We are about to lose a lot of supply from the market, and I don't think the Saudis are going to make that up. I think the Saudis, want the market in around the level. I don't think they really want to see the market get, really hit here. So I looking at the balances, the supply demand balances for fourth quarter, we're going to draw inventories, and it could be as much as over 1 million barrels a day. And it isn't like, even though these stocks today have built, it isn't like inventories are anywhere near the surplus we saw a couple of years ago. So, we're going to start drawing. And the other problem is there's not that much spare capacity. So if something goes wrong, which when you look at the producers, look where the producers are, look who they are. You look at Nigeria, Venezuela, Libya.
What about though on the global macro side? It seems like actually a few guys on our website, Kai, yesterday was mentioning it on his podcast. A few of the PMIs seem to be slowing. Emerging markets are now down about 20% for the year. What about the idea on global growth maybe not being as strong and affecting global demand?
Right, and when you look at when we talk about the balances, we definitely it's interesting that the IEA report, the OPEC report, and the EIA report, have all come out, and they haven't yet revised demand down on the growth. But you're still looking at pretty healthy levels of growth for next year of like 1.3, 1.4 million barrels a day. Even if even if we get another, let's say demand slows, is it going to slow to like zero growth? Nah, it's not going to be zero. It's going to slow by like, a couple of 100,000 barrels a day or 300,000 barrels a day, let's say. It'll still mean that there's a deficit in the market, even with the slowing growth, and we're still going to get these stock draws. Now, sentiment is something completely different, and as we know, Mike, markets can overshoot on the downside, but I don't think you're looking at like a complete destruction of demand.
Markets never overshoot or undershoot. They always know exactly what's going on.
Right.
Always.
Exact, yeah. But even if we had, we'd have to go into a big time global recession. I don't think we're there yet.
No, it seems like a lot of indicators are still showing.
For us to not grow on demand, you're looking at a big recession, because the forces, you look at the big macro forces of energy, and we're still growing. There's still petroleum demand growing in in China. They're not going to go down to zero growth, or India, they're not going to go down to zero growth. It may slow, but it's not going to be zero or negative. Clearly, if it's negative growth on petroleum demand, we'll be in a global recession. So I still think the bullish story is there for oil in 4Q and 1Q. I don't think it's there. I read some of these fund guys are looking at $150. I guess they've been buying $100 call.
I saw on Bloomberg they've had articles like that. That's when we were about 2 weeks ago when oil was above $70. Now the articles will probably shift the other way. But yeah,
Right.
we'll
Now they go
definitely
the other way. Now
right.
they go, oh my God, demand's going to go down to, we're going to get crushed on demand.
Yeah,
And when you do it's not going to happen that quickly.
sure, sure. All right. Well, hey, thanks a lot for the great information. Thanks for the timely update on the energy number update, and thanks for all the help. And we'll be talking to you soon.
Okay, Mike. Thank you. Thanks for having me on.
All right. Have a good day.
All right. See ya.
All right.